Welcome to YP Investors Quick Tips. In this episode, we'll be going over how to grow your 401k. So let's start with the YP Investors website. This is the home page. From here, let's check out the YP Investors blog. There's some very helpful articles on here. You should definitely check out. So at the top, we have a new article. It's about 401k and the benefits of monitoring your retirement accounts. So let's check on this and see what we have in store. So let's scroll down to the strategies that you want to use to improve your 401k account and your return on your investments so that you can retire when you want to. You know, a lot of people think if you have a 401k, you're going to be set no matter what, and you just, if it's part of your company benefit, as long as you're putting some money in it, you're going to be great. But unfortunately, that's not true. A lot of the plans and the fees are not so good, so they're going to end up eating away at your investments. So let's look at some of these tips to successfully grow your retirement account so that you can retire when the time comes. So how much money should you put into your retirement? Always take the company match because it's free money. So this means if you put a certain percentage in, let's say you put 6% in, the company might match 4.5%. Sometimes they match exactly 6%. But anyways, if you put 6 in and they're matching 4.5%, you're going to be getting a total of 10.5% into your retirement account each year with only putting 6% in. So you're getting that 4.5 extra for free, and that helps to eat away at those fees. So if you want to invest more than what your company matches, though, a very good strategy and the one you should be doing is opening a Roth IRA and putting any extra you have in there. There are limits for each year, and in 2018 the limit was $5,500. But your Roth IRA is a very powerful investing retirement account because you put money in that is already taxed, so when you take the money out, it's tax-free. So in this example, if you invested $5,500 each year for 35 years, the total investments would be $192,500. And if you do an annual growth rate of 10%, which is pretty reasonable, the Roth IRA would end up being $1,639,697. So you made almost 1.5 million tax-free. And when you want to take this out, it's all going to be tax-free, as long as you're past the retirement age, which is 59.5 currently. And for YP investors, this 10% annual return is very feasible. There's plans that we've gone over, including the sector investing plan, that you can gain almost 20% a year pretty easily. So what strategies can we use besides the company matching for the 401k plan? Well, it's very simple. You look at YP Investors' current market conditions. So let's pop over to our member homepage. This is one of the great features of YP Investors. We're going to have to log in quick. Since I'm not logged in yet, if you click on home, the home page will go to the front page. So we'll just go through a quick login process. And then if we click home here, just to expedite this, there we go. Member home should pop up once you're logged in. So this is a great homepage feature. You have the recent forum posts, you have the market conditions for you, and then you have the top technical stocks and the top sectors. But the current market condition will be on this homepage, so you can check this and you can click on this to go to an article about the strategies you want to employ for the current market conditions. So since the market conditions are good, we can see buying is in control. So let's go back to our retirement plan. Now it says when buying is in control, conditions are good or very good, you want to select a stock plan that mimics S&P 500. or a plan that will outperform our market, consisting of 100% stocks. You want to be in all stocks because the market conditions are good. Most of the stocks are going up, so you want to be in all stocks. That's how you're going to be growing your account. So some sectors or some plans have a lot of stocks in there that are heavily weighted, and this can be good or bad. If most of those stocks, let's say you have a 5% in Amazon and then like a 2.5% in Apple, and then the rest are about 1%. So you have a couple heavily weighted stocks. What you need to do is go into the stock selector and check those heavily weighted ones like Amazon and see. Let's check the technical attributes for Amazon, because this will be an indicator of how that plan is going to do. And we can see right now Amazon is not beating the market in the long term, and it's a negative trend. So maybe you don't want to do that, invest in that stock plan, maybe a different plan that mimics the market better, because if it's heavily weighted in Amazon, it's not very good because it's in a negative trend right now. And let's check Apple. Now Apple's in a positive trend and it's beating the market. So now you have two stocks that are heavily weighted. One is bad, one is good. So maybe you still want to be in that plan. So what you want to do is you want to go through each of the heaviest weighted stocks for that plan and make sure that they're beating the market, or at least in positive trends. And if not, pick a plan that mimics the market better. There should be some plans in your retirement account that are general S&P 500 plans. And as long as they're all stocks, you're going to be doing well. And then if the market conditions switch to bad, or very bad, where selling is in control, so we can go back and check that out quick. They also have the market conditions here on our YP Investors stock selector tool, which is also very nice to have. So you can, while you're analyzing stocks, you can make, oh, okay, the market conditions are good. But if they are bad or very bad, you're going to want to switch your 401k plan into all bonds. And not just any kind of bonds where they're junk bonds, which means they're high yield. You want safe bonds that are going to preserve your wealth, because this is a part of a time of the year when the market's not very good and it's shaky, and you want to start preserving your wealth. So you want bonds like U.S. Treasury bonds that are guaranteed to preserve your money. You might get like a low annual yield, like between 1% and 3%, but your overall account value should remain the same during this shaky market period. And then once the market switches back to good, you go back into the stocks and continue to grow your account. And this is how you're able to significantly grow your 401k versus using those other plans where they're a mixture of stocks and bonds. It's great for a thought, but it's just very counterintuitive, because they'll put you in a plan when you're older of all bonds, which you're going to be basically losing money, because you're going to be, if the stock market's booming, you could be making 10 to 20% a year, and you're going to be making maybe 1 to 3%, and then minus all the fees, which could be 5%. You could end up losing money in your account. And if you're young, you could be in all stocks or mostly stocks, and they'll just have you in the stock, 80% stock, 20% bond, or whatever it is, and you'll just follow the stock market. But if you gain a bunch and then all of a sudden the stock market goes way down, it takes so much longer to gain back. So you definitely want to be switching when the market conditions switch. And with YP Investors, we have the automatic updates anytime the market conditions switch. So you definitely want to be a member of YP Investors just for that fact, the automatic updates. You get the email, you go into your account, and you switch it over to stocks or bonds, depending on the market conditions. So our YP quick tip for you today is to be aware of the current market conditions and have a strategy for your 401k so that you can retire when you want to. Thanks for joining us today, and good luck on your investments.